Anshu, of course, we're looking back at the anniversary of the financial crisis, not that it's something to celebrate. Tell me about your job at the time. You were at Deutsche Bank.
I was running global markets at Deutsche Bank in 2008, if that's the time frame that we're talking about.
And that entailed what?
I had responsibility for, as the term implies, the equities and fixed income businesses of Deutsche Bank.
And you were co-head of the investment bank, more broadly speaking.
And co-head of the investment bank with Michael Kors, who was responsible for investment banking and corporate finance.
So here's an important question. We know now that the crisis was well underway in early 2007, even late 2006. Yet almost everyone who was running, and I mean everyone who was running a financial institution at the time, missed the signs. Why do you think that is?
So I don't think the signs were missed, Erik. Quite honestly, I think from fourth quarter 2006 onwards, the drum beats had begun. So the warnings in subprime of fourth quarter 2006, the fact that credit markets were in trouble first quarter 2007, one of the Bear Stearns funds collapsed summer 2007. So the fact is that the de-risking and concern around credit and mortgage markets had existed for a year and a half. I mean, quite candidly, we were in active de-risking mode from July 2007 onwards.
Is that when you realized that the stress was not going to be contained in the mortgage market and that the financial system, as it were, was, if not imminently headed over a cliff, was headed in that direction?
No, I would actually, and again, each person's recollection will be different. Don't forget, we'd gone through the Asian debt crisis, we'd gone through Russia, we'd gone through LTCM. So I would say all the way till summer 2008, it felt like a really bad market crisis. So the period from first quarter 2007 through summer 2008, all the way through Bear Stearns, by the way, it was clear that the system was under stress. It was clear that credit and mortgage markets, fixed income markets in general, were in trouble. But it still felt like a market crisis up until that fatal weekend.
And there was still liquidity.
Not only liquidity, if you go back and take a look at the stock market, you had a complete delinking between fixed income and equity markets. The equity markets made all-time local highs, i.e. highs for that 4-year period, in, I believe, November 2007, long after fixed income participants could clearly see that credit and mortgage markets were in trouble. So in fact, if you were hedging, your hedges were getting squeezed.
Incredible. Do you recall the moment, Anshu, when you felt real fear?
Mm-hmm. So, look, there'd been fear all along. When you run markets, fear is a constant companion, okay? But perhaps panic might be
a better word.
A better word. And I would say it is, for me, the week post-Lehman. And I'll tell you why. I'd gone through LTCM, which was a far smaller balance sheet, far less systematic, far less systemic, one should say. And the regulators had pulled all of us in again.
Famously into a room.
Into a room.
At the New York Fed.
Absolutely. And we walked out of that. No one was happy. No one was petrified. We all felt we had a solution. Okay. Bear Stearns. They provide second loss financing to JP Morgan to incent JP Morgan to take Bear Stearns over. So the Monday after Bear Stearns didn't feel nearly the same. So the biggest thing which struck me was not the fact that Lehman was going into insolvency, but there was no statement, there was no agreement. When it came to derivative counterparty risk, when it came to prime brokerage unwinds, there was a whole series of very complex questions that Monday morning, which no one had the answer to.
So we can ask at least a question now, which is, and it's been asked many times, could Lehman have been saved? Should it have been saved? Should something else have been done? Would it have helped?
So the game theory of that weekend has been poured over way too closely for me to add anything incremental or intelligent to that discussion. What I will say, the decision to keep Lehman or not pivoted around a whole set of factors, and every attempt was made, and we know what those attempts were. More of an effort, perhaps, to control the way these issues were going to be addressed, perhaps, is the one thing one can point to. Easy to sit in judgment today.
Yes.
I do have to say this because I really respect the people that were involved, and frankly, they are the ones that created the plan, which allows us to sit here so calmly talking about it 10 years later. So I don't want to sit in judgment on that. you're asking me as a practitioner, when did life change? I would focus in when the money market funds broke the buck that week, because I knew what
2
that
or 3
meant.
days after the bankruptcy.
I think it was the 16th or the 17th.
Yes, on the Wednesday.
We had the benefit to be very stably funded with deposits and all the rest of it, but I knew what that meant for the wholesale.
So Lehman was the fulcrum point.
For me, yes.
Before Lehman and
Look,
after Lehman.
We had plenty of issues to deal with, and I don't believe even if Lehman had been dealt with perfectly, the world would have been a happy place. We had all kinds of issues which have been famously catalogued about lack of liquidity, lack of stable funding, all that the agencies had to be dealt with. AIG was coming. I'm not saying those things would have gone away. All I'm saying is perhaps the reaction time would have been slightly more generous, and maybe the stress would have been less severe.
Here's a question for you that's still relevant today. Is there anything in your mind the Fed could have done or perhaps should have done to prevent the buildup of credit risk in the financial system?
Very hard. In the times that we had leading up to the events of 2005, 6, 7, yes, today we can say the buildup of leverage was very rapid. Hard for me to sit here and be wise after the fact on that.
Do you think the mandate, and this is a complicated question, but as a practitioner, that the mandate of the Federal Reserve as a central bank should be extended beyond, obviously, inflation and employment, and to something akin to debt monitoring or credit monitoring?
I mean, the New York Fed obviously supervises all
Yes.
the financial institutions very directly. How much more direct supervision would you want?
Well, the question then becomes, if credit or the accumulation of debt crosses certain thresholds, is there something that the regulator should
Well, the
do?
debate you can have is not regarding the banks, where the regulators have all the powers in the world. The question can then be extended to markets like the ETF markets, the hedge fund markets, the unregulated parts of finance, which is a very deep question with all kinds of positives and negatives that come from it.
In your mind, Anshu, is there an adequate explanation for the collective failure of risk management on Wall Street?
Way too complex to give you an adequate. There's multiple factors, and I think they've been poured over and well identified. Lack of liquidity, lack of stable funding. There's a whole variety of factors that came together. It was a confluence of a lot of themes.
How much of the financial landscape we see today was shaped by the financial crisis?
Very heavily, as you would expect. You cannot come to the conclusion that the events of 2008 were the most dramatic. Certainly, I've been a practitioner for 30 years. Nothing else comes close. And if you're a student of financial history and you go back multiple centuries, nothing comes close to the events of 2007-8. Okay? And so it's completely unsurprising that the rules, the practices, and the state of the financial services industry today is utterly defined, in my opinion.
What
by those
specifically?
events. Again, I'll stay within the constraints of the short time that you and I have to chat, and I'll really go to the major blocks of things which I can see. Some of these are intended, some are less intended. But certainly the capitalization of deposit-taking institutions has been altered completely. We will all agree that there was way too much risk per unit equity in the summer of 2007. We'll all agree that stable funding, which by the way was the number one cause. If you ask me, the demise of the overwhelming percentage of institutions that didn't make it happened because they couldn't fund their positions. And certainly the amount of stable funding which you had versus the liquid assets you owned was again completely out of whack, which is correlated to the first point, but independent. Business practices, banks were doing way too many things. Overall leverage in the system, not just with banks, but with non-banks, insurance companies, hedge funds. So all that had to be changed and has changed. I think the question you're asking me is how much of the world as we see it today was shaped in 2008.
Yes.
First thing which I would point to is the fact that banking today is dominated by the behemoths. And now that perhaps is an unintended consequence, but when you set the minimum standards of capital that high, inevitably what wound up happening is that a few firms have tended to dominate wholesale banking, almost all of them American. So those are the two things which I would say are different today versus a decade ago.
You get $3 trillion balance sheets.
You get $3 trillion balance sheets, and you can say there's $1 trillion market cap companies now which didn't exist back then. So one end of finance is completely dominated by those behemoths today. Okay, with all that's good and all that could be concerning about it. The second thing is price discovery at the margin, Erik, is being done by the central banks. So you've got both these things happening at the same time. You have banks being categorized as regulated utilities. Who is the marginal price setter for credit? In Europe today, it's the ECB. For the longest time in the US, where mortgages were priced was driven by the bond buying program. Pivot, flatten the curve, tighten spreads. Now, that is ebbing away finally in the US, will happen in Europe, and will happen globally. Banks and financial institutions generally need to come back into that price setting mode for the system to work in a more true price discovery fashion.
Are banks the ones to end up doing that price setting? And I ask that question for two reasons. On the one hand, they're highly regulated institutions that in many respects behave like utilities now. Secondly, the non-bank securities industry used to perform that function before 2008, and it's gone. Merrill's gone, Bear Stearns is gone, Lehman is gone, as we know. Goldman Sachs and Morgan Stanley are banks.
So that's a very interesting question. No doubt that banks were setting the marginal price of risk, perhaps overly so between 2004 and 2007. No one wants to go back to that again. You're making a separate but related point that the broker-dealer model, which I grew up with, I made my debut at a firm called Cantor Peabody, which no longer exists. So middle-sized firms which were dynamic, very client-focused, but wholesale funded, defined Wall Street back then. It
Yes,
wasn't JP Morgan and Citibank. It was Goldman, Solomon,
Yes.
Morgan Stanley. The firmament of the top players were those firms. Now, what's happened post the crisis is you have in the investment banking corporate finance space the hyper boutique, which has done very well. I believe there is room for the more middle-sized, not all things to all people, nimble organizations, and I think you will see some of that.
And that's in effect what you're doing now with Howard Lutnick at Cantor Fitzgerald, trying to build a firm of that nature, are you not?
There's many firms that will try and occupy that space. Yes, I mean, Cantor has always been in that space, and we're hoping to expand what we do.
Do you worry at all, Anshu, about the risk that is once again building up off of bank balance sheets in private credit, for example, and elsewhere beyond the purview of regulators?
So, Erik, the first thing which I would point out to you is the banks are in good shape. Okay, I know there'll still be debate around it. We've acknowledged the fact that we have behemoths, but these are well-run, highly regulated, well-capitalized, stable funded vehicles. So when the banks are in good shape, you have a stable anchor in one corner of the market. Now, have we had imbalances? Well, there's been lots of places of rapid growth. Some intended, some unintended consequences of the last 10 years. As the banks have shrunk their role, other firms have stepped in. As QE has prevailed, those low interest rates have produced flows of capital out of certain sectors into other sectors. And we know what many of those are. The concern that I would have is if the holding capacity of the firms or funds which hold those big assets is not stable, which is what we had in 07, 08, and I don't see that. So if we're talking about the ETF industry, we talk about closed-end mutual funds, retail, certain aspects of that world, which is where the assets are accumulated. You can say there's been very rapid growth. We should watch it all closely. How will they behave if valuations change? But I don't see an analogy to 2008.
Where do you think the locus of the next crisis will be?
Impossible to call. I would certainly say the things which I've traditionally looked at don't concern me as much. Sovereign balance sheets have to be looked at. So if you ask me to hone in, and not necessarily emerging markets.
You're not the only one to say that it may be a sovereign debt crisis. That's a reality, as plain as day.
You have many more tools to deal with a sovereign debt crisis. 2008 was what it was because there was no playbook. There is a playbook. It's not the most pleasant one,